webinars we're having. I'm Arjun here, and this webinar is largely for financial advisory community um, who who are seeing who are also witnessing the turmoil in the fixed income markets. It is clearly a very difficult period for investors and advisors alike in terms of the way the markets are behaving. And till at least till the last couple of years, equities have done really well. And so investors have been ignoring the poor returns on fixed income investments. But this year, with equities too showing high volatility, fixed income is again gaining forward. And typically, in periods of high volatility in equities, uh, advisors are advising clients to uh, uh, stabilize portfolios through investments in fixed income. But however, with fixed income too showing extreme volatility, so here we have a period where equities are volatile and fixed income is volatile. So where do investors go? And inflation is rising. This is one of a very difficult period for anyone, right? It's not the easiest of places to be in uh, because there is no precedence to what we are seeing here. Now, and why I'm saying this is likely because even during the past years of crisis, there has been some room for central banks to play. But so even in the 2008 crisis, there was enough room for the central banks to increase balance sheet size and cut rates to record lows and do all sorts of measures to improve the market sentiments, add stability and economic growth. But in this period, it's becoming more and more difficult. One is because rates are already at record lows. The second is because yields are extremely low and inflation is rising, which I think has taken them completely off guard. And third is that the balance sheet sizes are hugely bloated. And further amounts of money printing is just not going to help. And the fourth is that government borrowing also at record levels. Debt has gone up very sharply. And hence, with all this, central banks just cannot do anything to help investors. So here the investors themselves have to look out for themselves. Now, it's just coming. The whole area of this agenda is that with if equities are volatile and many perceive that valuations are very high, and also that there is a need for fixed income investments, and but fixed income is just earning nothing and earning much lower than inflation. Now, what are the options available? And given that many investors do prefer to have part of the portfolio or a larger part of the portfolio in stable assets, then where do you invest in fixed income? Now, this is an opportunity for advisors as well. If you're a financial advisor, you have an opportunity to um, uh, uh, um, uh, increase your assets under advice or under management, depending on what kind of an advisor you are. If you're a pure advisor or a distributor, uh, in terms of revenue models, clearly it's asset under advice or management. It is a big opportunity for financial advisors. And the second is because the need is already very heavy and solutions are just not there. And the second, the so hence it is if advisors can help investors through this period through fixed income and help them position their fixed income portfolios to or investments to earn more than inflation, add stability to portfolio, and ride out volatility in all markets, then it shows that one is that the investors do need would be willing to entrust a larger part of the savings on fixed income to the advisory community. And right now, a lot of it goes into passive investments like bank deposits. So, and also in the current context as well, the traditional products are just not delivering. So, what are the new products that you need to focus on? So, let's go down to what is the agenda for today. One is inflation is eating fixed income market. It's a pet theme for INR bonds. Now, the second is most important, which is a huge need for strong advice on fixed income. And this is where financial advisors come in. And then the financial advisors themselves must choose the right fixed income products for their clients. And so here, hence, in this period, if you look behind and if you look at what investors have already been investing in and the same plain products and what's happening, it may not really add value to the investor. So what advisors need to do is work very closely with them to given that fixed income portfolios a very strong footing where they earn enough to protect themselves against inflation and also protect the portfolios against volatility and also achieve their long-term savings goal. Now, let me go again to our pet theme, inflation is eating away returns. Here we are just showcasing here in this, we are just showing that in the slide, what we are showing is the returns returns that products are given and what has beaten or underperformed inflation, right? So if you look at this particular instrument in slide, it gives you how FD rates have performed, mutual funds have performed, and how they have fared against inflation, and what is the earnings lower than inflation. Now, again, if you accumulate it, this is again, if you take the other fund categories against inflation, these are the top losers against the inflation. And if you take AAA corporate bonds and Bharat bond ETFs and all that, they still haven't really outperformed inflation. But where the delta has really come in, or alpha, is through the InvITs and through the corporate bond routes. So you have A-rated corporate bonds and AA-rated corporate bonds as well that have done really well. So that's one of the reasons why you have the last year was a surge in MLD issuances, market-linked debentures. Especially these were of companies that were rated across the rating curve, and there was a huge demand for this because one is it offered investors, leaving aside the tax arbitrage, is for the ultra high net worth, depending on how they treated these investments. On the overall face of it itself, they offered some kind of a protection against low inflation and low returns in all other products. So now, as a financial advisor, what do you need? Two things that you need to look at in this current scenario in terms of what you need to focus on and what should be the position of the portfolio. So first is obviously if you go down the rating scale, if you go down, or if you go to the corporate bond levels, then you have the credit cycle. So you have the credit cycle, and the credit cycle is clearly defined. Depends on the business cycle, the economic growth, the outlook for the corporates, the guidance given by them, the level of investments, the level of requirement for working capital, and all that. And to a very large extent, this seems to be very positive. The last couple of years, we have seen a lot of industries that have been sick actually turn around. And these are from largely including textiles and infrastructure. Textiles have been sick for almost 10 to 15 years, and suddenly they've seen a revival. We have seen chemicals doing very well. We have seen infrastructure obviously coming out of their woods. Commodity cycle, commodities that have been languishing for almost 10, 12 years, they have come out of the cycle. So all that, so and these are the industries that have been very highly debted earlier as well. And now with the balance sheets improving, so the lending appetite for also the lenders have increased. The second is also in India, what we are seeing is some kind of a lending revolution. More and more fintechs are coming up, which are offering credit to retail customers, MSME and SME, on a tech platforms, on a technology-based platforms, largely enabling them to access credit, even though the rates are high. But at least the credit access is much easier for them now than earlier. Earlier, they had to go to a bank who used traditional methods of evaluating credit. Many of them didn't get it, so they had to go to unorganized market, which the rates were usurious. But at least now the whole thing has become organized through fintechs, and there's a huge amount of lending happening on the unsecured side, the secured side. But the main part is the access to credit has really improved. Now, this is a very important factor for advisors and in fixed income investors, because as this has come about, this kind of a credit revolution, then the options for investments are also increasing, because whenever there is a loan somewhere, there has to be a borrowing somewhere. And many of these companies are now coming to the corporate bond market to borrow. And even when they are coming to the corporate bond market, that end borrowers are also coming to the corporate bond market, because once they get credit, they are able to perform better. And as they're able to perform better, they are able to come to the bond market directly to lower their cost of borrowing if they are improving their business fundamentals. So it's a whole cycle, and this can play out very well. And this is a very important cycle that investors need and advisors need to understand, because it creates a huge amount of options for them to improve their portfolios. Now, coming on down to the interest rate cycle, it's clearly on the interest rate cycle is clearly rising, right? And it's rising very sharply. And the question is, where is it going to stop? But the best part of it is, so this clearly in the rising interest rate cycle, and I keep saying this, and I've been saying this for a while actually. It's not even that it's a rising interest rate cycle. It's a cycle where, especially in the global side, it's a cycle where the traditionally highest safety, like a US Treasury, is the highest risk at this point of time, and that's largely because they are just not they're just not there to um, increase. They're just not able to perform to beat inflation. So we keep putting out notes on this. All our a lot of analysis we put out on this. We're saying that if you are a US Treasury investor, and even if inflation comes down to 3% over the next 3 years, fixed income investor investing in US Treasuries would have to be earning something like an annual of 15 to 20% just to recover the losses based on the investments in US Treasuries that have been hit by inflation, right? So interest rate cycle is clearly high, and this completely takes away the fact that it's highly risky to invest in a government paper, an GSEC paper, a government bond, largely because one is that governments are also borrowing. Central banks have with floated balance sheets are no longer able to uh, um, uh, support the government borrowing, because the more they buy the government papers, the more they add to inflation. And with Fed and everybody, ECB, everybody else looking to reduce their balance sheet sizes now. And this is not going to help. And the third is that the rates are so low that there is a long way to go to actually even come to some level where it can be protecting against an inflationary environment. So the rate cycle is low, and any very high safety borrowers, which is government run or very, which is also very in terms of spreads to the government bonds are very low spreads to the government bonds. They are just not offering anything that is protecting investors. So hence, clearly, the credit cycle is there, and with the credit cycle that is showing signs of coming up very fast in India, then you have the place to look for is definitely the corporate bond side. And fortunately, in India, it's become, I think, from what we are seeing at our vantage point here, running a digital bond platform, we are seeing that this is gaining more and more ground. Right. So I've just spoken to you about the Fed and what they are planning to do, including RBI. RBI obviously has to start normalizing policies. They've already started to, show that they're not protecting the 10-year itself, which they're doing last year, which itself is a big sign that they're giving way to higher inflationary expectations. So these are some charts of the 10-year US Treasury and the government security and others, inflation charts, etc. For your own consumption. Now, so let's come down to the fact that investors have last year in their traditional investments have lost out at least 2% or even 3%, depending on what kind of inflation they have been facing. But in a very simple terms, if you have invested in a traditional product and every day when people go and buy stuff or pay salaries for their employees, etc., everything what they are getting from their investments is just not enough to make up for the rise in costs of the goods and services that they are paying for, right? So that's very simple. And clearly at different levels, there are different needs as well. So there is becoming a huge need for advice on fixed income products, right? So what has been the best performing assets last year, and what has been also the fact that how much of assets have underperformed. So if you just look at this amount of fixed deposits itself, as you all know, it runs into trillions of rupees, and mutual funds itself, all the traditional products which have underperformed, they are also running into some few trillions of rupees. So this amount of money is there to be wanting to be invested better, to earn better returns, to work for investors and just not be there. And also, and if this money is waiting to be moved out and searching for solutions, and this is the best opportunity for financial advisors. And financial advisors here need to tap into this opportunity. One is clearly because of the need for investors to tap for better solutions. And this is going to be the most important factor that is going to drive assets of the advisory community as well, because the assets and the fixed income is very, very low for them. But earlier there were no products, but there are more products that are coming up, and that is going to be the biggest driver for the advisors. Now, So what does advisor need to do? Obviously, understand the client's needs, preferences, depending on the risk profile, all that. But even more very basic understanding is to earn higher returns, keep stability in capital, and protect the portfolios against volatility in equity and other markets, and also make sure that it's earning higher than what the cost of goods and services that they are paying for. So this is the opportunities that advisors need to identify. So what they need to do is to look at the new products that are coming up in the market, evaluate in its own merit, how to what are the availability. So in to a large extent now the market is evolving. Earlier, a retail investor could not invest in corporate bonds, but now there are more public offerings. So investors can invest as low as rupees 10,000 in these public offers. You had more and more issuers were largely very institutionally placed. So an issuer used to go to Narendra and all that, and it was privately placed to few institutions in mutual funds, insurance companies. But now more and more issuers are coming to the retail market in HNI and the ultra HNI market to raise funds. Like I mentioned, the whole market linked debentures, which was, I think, could have totaled 15 to 20,000 crores last year, all went to retail or uh, HNI or ultra HNI investors. So that amount of money that has gone to that kind of an investor category, and that's going to continue. So as more and more issuers access the corporate bonds to give funds to retail and individual investors, then the, uh, these will give that much more options to them. And financial advisors here are necessary because investors do need to know what is the product they are investing in. They can't only look at the higher returns, but what are the possibilities of risk? How is it going to fit into their portfolios? How is it going to manage their cash flows? How is it going to suit their requirements in terms of objectives, short, long, whatever specific objectives? So many other things are also there that investors need to would want to look out, and financial advisors are the best people to advise them on that. So here it's giving you a huge opportunity here for investors or for advisors to identify the new products and to give it to investors. Now, to a very simple, coming to a very simple asset that has outperformed inflation by a very large extent last year was the InvIT. And this included the power grid InvIT. And why are these InvITs outperforming? If advisors can find out, have an understanding of InvITs and rates, and if power grid investor return 30% from the IPO price, then that's clearly a very strong uh, signal that these kinds of instruments can return very good can give very good returns for fixed income investors largely, well over and above all the other traditional, or the best part of it is that all you need, however, InvITs can be invested like that as one invests in equities. So InvITs and rates and more of these instruments that come up as India, as the government is now looking at a $1 trillion of 1 trillion rupees of 100 trillion rupees of infrastructure spends, they would need to start to monetize a large part of their assets to raise capital for this, and that will be done through all these products like InvITs and others. So it's very important for advisors, and also you have um, many PSU issuers that have floated bonds that are very attractive. For example, NHAI floated its Mumbai Delhi Expressway, Delhi Mumbai Expressway project. This was a very attractive offering something like almost 300 basis points over the treasury bill yield and had a staggered uh, maturity and a staggered redemption. And also, it was a very large issuance as well. And this bond really did perform very well on listing. So if these kinds of products will come more and more, and these could be very highly opportunistic for investors and advisors who can identify and put it in investors' portfolio are, are, are really doing their job in terms of and earning their fees for the advice, right? So the opportunities are going to be more and more and tremendous. And then you can create different kind of portfolios, uh, like um, uh, depending on the needs of the investor. We in INR bond itself, we have promoted ladder portfolios, staggered maturity bonds. We have even promoted something called a Goldilocks portfolio, which has got more liquidity than a sovereign gold bond, and all these kinds of portfolios that can add value to the investors as well as earn much more returns than what they have been traditionally getting and underperforming inflation. And see how cheap each of these bonds are in terms of expenses, etc. Each of these, hence, it can really work out very well if advisors can uh, identify the right opportunities for their investors. Right. So most important now is so once the investors have the need, it's a huge opportunity of assets waiting to be shifted into uh, products that are actually making money for the investor over and above inflation levels. Also, a huge opportunity to actually create health portfolios, meet financial goals at the same help investors save better, and hence choosing the right product is the most important. And like I was mentioning, options, more and more options are coming up. You have listed options, you have corporate bonds, you have MLDs, you have many other, then you will have global bonds, you have so everything else will start to come up. Financial advisors who are able to understand these products, able to understand the risk, able to understand the benefit to the investors, able to help get the information. And the best part for advisors and investors alike now is that platform are becoming bond platform, more and more electronic bond platforms are coming up. INR bonds has been in the forefront of an electronic bond platform. We are unique in the sense that we provide the best information, our own credit proprietary risk model, etc. We give a lot of knowledge in terms of understanding the product. So if you need to know about InvITs, all you need to go to is INR bonds research or YouTube to find out about InvITs. We do webinars like this and many other things for advisors and investors alike, especially for advisors, as INR bonds believe in working very closely with advisors to take the new products to the investors. Um, so, so clearly, with this, I think what I will do is I'll open this call to any questions anybody has here, and we can take it forward from there. You can either raise your hand when Nikhil will unmute, or you can put it on the chat, and uh, I'll answer the questions. And if anyone has come in late for the webinar, the recording is there and they can always reach out to us for any more queries directly. So since there are not too many of us, I mean, we can have a wider discussion if anybody is keen on uh, getting to know or stating the views, etc. We're very open in this webinar. So INR bonds has got, we have training programs. We have for financial advisors specifically, a 1 month training program. This costs 5,000 rupees. This is to help advisors to um, understand the bond market and help them solve problems for the investors in fixed income. We also have a partner program where we partner with advisors closely, work in providing solutions to their clients, also bring products to their clients. We have bonds listed on our platform. We are helping investors and advisors help invest in bonds through our platform, the right bonds, and uh, fairly. Uh, what we can definitely say is over the last 1 year, all our all the investments done through INR bonds, Quick Invest has outperformed every other product, beaten inflation as well as outperformed by 4 to 5%. Uh, that's a kind of outperformance. We have been able to guide investors and advisors to show the best maturity bonds. What are the bonds that are best in class in that category? How to look at the risk, etc. As also guide them on the cycles, interest rate cycles, etc. So most of the investments have been in a maximum of 2.5 year kind of a maturity, which have already been drawn down to some extent now. And all the bonds that have been given to investors are outperformed by a very wide margin. And we'll continue to do so. Uh, we ask, because as we are one of the prominent players, we get access to most all the options that are available in the market. We have our own research. We have our own models on risk. So, and we have the most data. Hence, we are able to price everything to the best available, to the best for the investor. We have an app, Quick Invest by INR bonds. You can see a curated list of bonds. In our web interface, we have two interfaces. One is the Quick Invest, where you can see more bonds which are not curated. But all bonds available on Quick Invest are placed in Quick Invest are available. So there's no question of non-availability. And we also have a wider bond uh, called Market Watch platform, where there are a lot of bonds listed, all the offers, so investors can look at what are the bonds options available, compare prices, yields, etc., and have a much better understanding of what are the levels of yields or returns available in the market for various bonds. Yeah, sorry, if you have any questions. Okay. So thanks, Rohit. You can always reach out to us for anything else. Anybody has any questions? You know, go ahead. If not, what you can always reach out to us. We'll also reach out to you and see if how we can work together to take the best options for your investors. Do attend all our webinars. If you have attended this webinar, then you will get a free subscription to Quick Invest, which is 200 rupees, worth rupees 200 for a year. And we will be sending you the access details for Quick Invest. So do we have any questions or?
So no one raised their hands or nothing on the chats.
Chat, right? Okay, fine. Then we can close the call. Yeah, thank you very much for listening in. The presentation will be sent to you, and you can always get the recording from us. And also, we will give you the Quick Invest access and anything else. We will please get in touch with you, or we'll get in touch with you for helping you build your assets. Thank you.
Thank you. Closing the call.